that. Okay, good to go.
All right. Good morning, everyone, and welcome to our presentation on finding the right loan for your client. My name is Chris Palermo of Universal CIS, and today I have with me Ryan Paquin of First Home Mortgage. Ryan's been a branch manager at First Home for over 15 years. Ryan is also the #1 originator of the Maryland Mortgage Loan Program. And you just reached a milestone this year too.
Yes, yep, just passed $1 billion in business with First Home.
Congratulations.
Thank you.
Now, with all the programs and assistance that's out there today, it's got to be really difficult to figure out which path to take. So we would like to hear from you. What is your process? Where do you start when you first talk to a borrower and then navigating through all those programs and assistance that's available?
Yeah, so I mean, look, there's so many different options. There always have been, right? Between just conventional FHA, VA, USDA loans, and then you throw in the Maryland Mortgage Program, the Chenoa Program, Federal Home Loan Bank. There's so many different options. So, and we get a lot of clients that come through the state of Maryland to us. So they're asking for specific programs. And we just say, hey, look, let's just start by pulling credit, right? We'll have you fill out an application. We'll pull your credit. We'll do an assessment. And we always tell them we're going to help you figure out a way to maximize your credit scores, right? So that's our first step in the process. Okay, so from there, some clients might be in the 500s, some people might be in the low 600s. We kind of determine what we need to do to get them in a position to buy. Okay, if they're ready to roll, if they're in the higher 600s or 700s, it becomes pretty easy. We typically say once you're over a 680, we're going to start looking at a conventional loan. Okay. If you're under 680, we typically want to keep you in an FHA loan because the mortgage insurance becomes too expensive if you can get an approval. It's hard to get an automated underwriting approval on a conventional loan under a 680. So, once we kind of analyze that credit, which there's a lot that goes into that, obviously you look at what their history is in terms of foreclosures and bankruptcies, and we don't see the judgments anymore, but those can pop up. So, if they meet the seasoning requirements on any of the bankruptcies, foreclosures, short sales, then we'll move forward with a conventional loan if it's over the 680, and we get the automated underwriting approval. And then we'll check the income limits, right? So if their qualifying income is going to be under 80% of the area median income, then they'll qualify for Home Ready or Home Possible. Fannie and Freddie's affordable housing program. We'll try to get them into that because then they'll reduce the mortgage insurance and they won't have any credit adjustments or not as much credit adjustments. So the rates are really good. And if we can't meet any of that, then we're putting them into an FHA loan.
Okay. So when you talked about seeing how you can improve somebody's credit, what are some of the products that you use to assist you with that?
So yeah, I mean, we automatically will look at the credit assure, I think it's called. So it tells us the potential increase. And so that's the first thing we look at. It's right there on the credit report. It shows you the potential increase. And if it looks like it's something that's going to benefit them, so if they're sitting in the 620s and we see that they can get up 30, 40, 50, 60 points, we'll run that analyzer. So we'll use the Wayfinder, which will tell us what exactly they need to do to hit that point objective. Or we'll use the what if simulator. If there isn't enough improvement through the Wayfinder, you can actually use the what if simulator and extend out the time. So maybe it's adding a credit card, which you can't do a rapid rescore when adding a credit card. You have to let it season for a month or 2 or 3. And so we'll look at the different timeframes and see what kind of impact that'll have on the credit scores. And some people, they have to wait 6 to 12 months before they're able to do anything. We'll call you and say, hey, we can't figure out anything to do here. Any recommendations, right? So, that is a huge tool. We utilize it every single day. We do a lot of rapid rescoring for clients that might have something on their credit report that shouldn't be there, right? So we'll have them reach out to the creditor, get us a statement that, says this is being deleted at the credit bureau level. If they give that to us, we can get our rescores back in as little as 2 or 3 days, depending on the bureau and how busy they are.
Excellent. Now, when you get somebody pre-approved, you guys go through like the full pre-approval process.
Yeah.
And say they're on that cusp of that score increase, would you switch them from, say, an FHA loan to a conventional loan during the process, or the way the market is today, is that too risky?
No, it's something that we want to do because, let's just say they're pre-approved for an FHA loan at $300,000, right? They're putting in a ton of offers. They're not getting accepted because there's this ridiculous perception out there that FHA loans are bad. And so listing agents aren't accepting FHA offers, right? So while they're pre-approved and out there house hunting, we're still working with them to try to get them into a conventional loan. So we're using that what if simulator to tell us, okay, if they're pre-approved for 3-4 months FHA, well, maybe now after that 4-month period, when we got to update their pre-approval, maybe they're now ready to go conventional, right? And so we'll flip them into a conventional loan, which makes their offer more attractive to the listing agent and the sellers.
So realtors still have a negative.
More so now than they have in the past.
Really?
Yes. Yeah. I mean, first questions they're asking is it a government loan or is it a conventional loan? And if we say conventional, like, oh, okay, good. We'll look at that one. If there's multiple offers, they're tossing out the government offers.
And it doesn't really seem, well, I wouldn't say fair, but I mean, the misconception of it.
That's the problem. It's this perception that it's a negative is ridiculous. And I get it from an appraisal standpoint. Maybe they're a little bit more strict on condition on an FHA and VA loan, but not really. I mean, it's not
a lot,
no,
right? I mean, when the FHA loan requirements, the house has got to be just like a stable house,
right?
Like
maybe some chipping paint, things like that. They're asking you to scrape and paint, chipping paint, but other than that, the conventional is very similar. Conventional appraisal is very similar to FHA.
Okay. Are we seeing appraisal issues right now?
Yeah.
With some of these prices?
Yeah. I mean, we're on these Facebook forums with real estate agents and lenders, and there's constant complaints about appraisals coming in low or just, not willing to, work with us as an ally. It's more of an adversarial relationship, which is really a shame because we all have the same goal, right? Help more people get in homes.
Right.
And so, if we have, appraisal that comes in $20,000, $30,000, $40,000 low, and the listing agent comes up with some new comps, good comps, and submits them, and they're just like, no, we're not changing it. It's like, well, let's be reasonable here, So we have an internal team of appraisers that works for First Home that will analyze that and help us. That's their expertise. I'm not going to profess that I have this, knowledge of appraisals and what the values should be. So I just lean on them to help us figure out what's acceptable to kind of dispute and, try to get a recertification of value or reconsideration of value. And that happens a lot on VA loans as well.
Now, if there is no reconsideration of value, you'll still lend off the appraised value. But what does the borrower have to do after that?
Yeah. So right now you're seeing, it's crazy times with people going $20,000, $30,000, $50,000, $100,000 over the asking price and waiving the appraisal, or at least saying, I'll pay X amount of dollars over the appraised value. So we'll lend based on the appraised value, right? So let's just say it's $500,000 purchase. They go in at $550,000, it appraises for $525,000. Well, our loan to value is going to be based on $525,000, and they're going to pay that extra in cash, that $25,000 difference in cash.
Okay. And then when you're talking to a borrower and you're talking about all these contracts, as far as the contingencies being waived, so you have the appraised value being waived.
Yep.
Home inspections being waived as well.
They are.
How about mortgage contingency? Is that still there, or is that being waived as well?
Some of them are waiving the financing contingencies. So yeah, that's normal. It's crazy. I never advise our clients to do that ever. Yeah. But the winning contracts are typically waiving contingencies, especially in, some of the high dollar markets, DC, Montgomery County, you're seeing a lot of that.
Okay. So when they're in the process, right, what are some of the things you tell them not to do?
Yeah. I mean, I think we've been saying it for however long we've been in this business, 20 years now for me. I always say, we're going to do whatever we can to not screw up your own loan, right? How to avoid mortgage sabotage is one of the things we're constantly talking about. And that is not opening up any credit, not going out and buying a car, not increasing your credit card bills, not financing furniture, or not switching jobs. Like there's a lot of things people do, and people still do it. We have a client that just got a $10,000 cash gift, and it caused the problem, right? No cash deposits. If you're going to get money from somebody, I tell the clients, any financial decision that you are going to make over the next 30, 45 days, you have to ask me first. You have to call us and we'll talk about it and put a plan together.
Right.
That's it. It's that simple. You're going through a process where you're borrowing $300,000, $400,000, $600,000. Ask permission, because begging for forgiveness in this industry doesn't work. Doesn't really work.
And then to make them realize not only, all right, don't do these things, but with the advancements in technology and the reportings that we get on the credit reports and all the notifications that we can get, yes, we are 2 hours before your settlement. You go to Raymore Flanagan and buy furniture, we're going to find out.
That's right. Yeah. So as well as I do that we get those notifications whenever new debt is opened up. I mean, it happens the day before, 2 days before closing, happens, throughout the process. So I tell them we're like investigators in the mortgage business. Our underwriters will find out. We run reports that tell us everything there is to know about you. So, and then we get alerted throughout the process if anything changes. So, we try to put, a little bit of fear so they understand how serious this is. And, 99 out of 100 clients listen.
Hey, but the day after, we're all good, right?
Yeah, we like to sell the loan first.
I do have a question for you folks.
Yeah.
If you don't mind me butting in. Actually, I have a couple of questions, but right now with the real estate market the way it is, it seems that the realtors are asking for new buyers to agree to a 30-day lending process, if you will. So how are you combating that with the potential for an appraisal that I'm seeing in the industry that could be 3 weeks or more in the making? How are you keeping those relationships with the realtors and also giving those buyers of yours the advantage of having the opportunity to get this contract, even if potentially their appraisal takes there's a long process there right now.
Yeah, so typically we're seeing maybe a max of 15, 16 days on an appraisal, which does give us enough time to close a loan in 30 days. Now, if you're utilizing the Maryland Mortgage Program, no chance. I mean, you're looking at 35 to 45 days to close Maryland Mortgage Program. And, look, if you go into the DC market and Montgomery County market right now, they're expecting you to close in 15 to 21 days. It's the norm. So it's hard. We have to lean on our appraisal partners to say, hey, look, I need this back in 7 days. And in some markets around the country, I'm in a couple forums where they talk about rush fees on appraisals reaching $800, $900, $1,000 for rush fees on an appraisal. And it becomes, we pass that on to the client, and that's like, hey, you want to close this loan in 3 weeks or 30 days, and I need to have this appraisal back because your agent wrote a 7-day appraisal contingency. Well, you got to pay for that.
Yeah, I feel like it's almost a crisis though, because the realtors are like, I've spoken to a few realtors that are like, we are not accepting contracts more than 30 days. And I can speak from personal experience that when a contract expires, I mean, it's like a threatening couple of days if you're not closing that day and you're like, I just need 1 day.
Right.
They want to, get out of that contract.
Yeah.
And potentially could have another offer that's higher in this market.
Always. They always do.
So,
yes. That's their claim, is they always have a higher offer.
Of
Cash
course.
with no contingencies, and they'll settle in a week. We do see that a lot, and we get those threats a lot. And so, sometimes we have to ask for a day or two on the appraisal. Our partners our appraisers they're overwhelmed. I mean, they're slammed. So it's tough right now.
Yeah, I think that's something the industry definitely probably needs to take a look at in the environment that we're in. Another question that was asked, how do you keep the clients that need to wait? Potentially you're working with them on their credit for 6 to 12 months without them going to another lender and getting an offer and more immediately. And I would speak to that probably, they're not going to get the same rate if they don't work with.
Yeah. So look, it happens no matter where they are in the credit process, right? I mean, if you don't nurture your clients and follow up, regardless of where they are in the timeline of buying, you're going to lose them, right? So it's all about follow up. So, we work with clients for years to get their credit fixed, and it's all about just staying in touch with them, putting a plan and checking in on them. And look, some of them are going to leave and go to another lender and get different answers. And sometimes that works out and sometimes they come home.
But in general too, like if you're a very driven person in this industry, you're going to build that business, because we all know that the refinances we've enjoyed are, somewhat dwindling and won't be as lucrative going forward. So these are potential clients that, you're making for yourself
Absolutely.
down the road, right?
Yes.
That's the key to that.
When I moved to Maryland in 2002, I didn't know anybody from the area. So I had to concentrate on the clientele that most people didn't want to work with. So that's how I got into credit repair. And I was working with clients in the 400s and taking 2 years to turn them into 580s, because back then we could do 100% financing with a 580 credit score. And so it took time, and I learned how to do that early on in my career. And it's worked out well, because now I get, a lot of real estate agents are like, oh, you need to call Ryan because he can work with the credit. And, I don't need to send them to a credit repair specialist to have them charge them money and work with them for a year and then have a bunch of disputed accounts and cause a problem for us on the credit report. We just tell them exactly what they need to do. Look, if you owe them money, you got to pay it, right? Go settle that account, get us proof, try to get it deleted, and we'll get it taken care of for you. And so I think when you have that kind of knowledge and confidence in what you're doing, to go back to your point, it goes to follow up and why clients don't leave, right? And if you provide a good service, they're always going to come back.
Yeah, and those folks may not have gotten an opportunity in the last few years with the volume and stuff. So
That's right.
I think we're heading into that. So that's a good point. And
Yep.
you have that expertise. So that's,
And they'll come back
Awesome.
again and again and again for their next house and their next
That's right.
house, because you built that trust.
Yeah.
You guided them through their first one.
Yeah.
Um,
And most people aren't willing to take the time. Most loan officers don't want to take the time to work with that client. It's just like, oh, you're not ready. Sorry. Go to a credit repair company. We nurture them. We take the time. And that's why it's important, those clients will always refer and they will always come back because, oh, you were the one person that was willing to take 20 minutes and talk to me on the phone. It's not hard. It's not hard to do.
And then your success at your branch, training your loan officers this process. Like, where do you start? Do you start with the loan programs? Do you start the credit, just to get them up to?
Yeah. So
Production.
Steve Lagana, the president of our company, he has said for years that you take good, smart, hungry people that have no experience and you train them from the ground up, right? So you train them to become technicians from the junior processor role through processing, and they get into production assistant. So we have this path that everybody takes in the branch, and they learn every aspect of the business.
Mhm.
And then once they get into that production assistant role, they are working on credit, they're working on pre-approved clients, but they've already been on the processor side. So they know how to be a technician. They know exactly what is needed up front, so not to cause a problem down the road.
And they also appreciate what everybody else is doing.
That's exactly right. That's exactly right. Nothing's beneath them, right?
Right.
Because they've been there.
Right.
Yeah.
I think it's the best way to do it.
Absolutely. It's fantastic. And we've built, at the beginning of the pandemic, 25 people in the branch or so, we're up to 42 with that same model, right? And I call it building the bench, right?
Mhm.
So you have the bench and then next man up, right? When they're ready, they either become a processor or a loan officer assistant or a loan officer. We have a few guys that just became loan officers.
Right.
Yeah.
And everybody gets to choose their path pretty much.
That's right. Yeah, 100%. We tell them in the interview, you go the path you want to take. We'll just guide you.
So the volume of business today is just immense.
Yeah.
The competition is insane.
Mhm.
We have to get people pre-approved fully day one. How many offers do you see these borrowers having to put in?
Yeah.
Say they can't throw out an extra $100,000.
Yeah. So we have some clients that just kind of give up because they know they need closing help,
Mhm.
right? And you're just not getting it in this market. So they're waiting maybe a year. They're re-signing that lease for a year. So I do think you're going to continue to see this for quite some time because there's a lot of people that'll come out of the lease this time next year that are going to be in this position again, right? So we have some clients that have written 25, 30, 40 contracts without getting them. And, you know, it just goes to, are you removing certain contingencies, right? Do you have that conventional offer? Are you having good conversations with the listing agents? Is the lender having a good conversation with the listing agent, explaining how great of a client it is, and they're totally vetted? And we've had clients write multiple offers on homes, not get them, and then the listing agent calls back, hey, this deal fell through. We know First Home's going to get it done. It's a VA loan, but you know, you were the next best. Do you want to buy this house, right? So it's like, oh yeah, of course. We've had that happen a few times in the last couple of months, and I think that's just, you know, if you're able to have a really good conversation with the listing agent and tell them as much as they want to know, explaining how good of a client it is, then they're going to want to work with you, right? As long as you're not being outbid by $30,000, $40,000, $50,000. I mean, we've won offers where we weren't the highest, but they knew it was going to close.
It's a dolphin. Bottlenose dolphins are thought to be some of the smartest animals on earth.
Muted. Okay, sorry.
There you go.
And then I don't know if I mentioned this in the beginning, but the presentation is being recorded. It will be put on the website later today or first thing tomorrow, mmBBA.org.
With the bloopers.
With the
Yeah.
bloopers that we just had. So,
Yeah.
So yeah, that's got to be a little frustrating for everybody.
Oh yeah, certainly.
It's
Yeah.
just waited.
And it's, you know, not just the clients, but the buyer's agents as well. I mean, they're working harder than they've ever worked because you know, they're showing more homes and getting less deals, right?
So what's different about this market now? Because we had a giant boom market back in like 04, 05. Why is this more stable and it's going to continue to move forward longer than that previous?
Yeah, I mean, back in like 06,
Yeah.
you could fog a mirror up and get a loan,
Mhm.
right? I mean, you had to have a pulse, and that was it.
No income, no asset,
That's
no,
No.
nothing. 480 credit
No
score,
doc,
yeah,
investment
yeah.
property, 100%
Yeah.
financing, right? Didn't matter. That's a true story. So you don't have toxic assets,
Mhm.
right? Right now, you have people fully qualified. There's no goofy loans. And I mean, there used to be a website, weirdloans.com. Weirdloans.com you would go to and punch in your scenario and it'd tell you what programs you could use. And it was like, oh, my client has a pulse. What loan can I use, right? And now you just don't have that anymore. You know, you have your non-QM stuff, but it's still based on qualifying and larger down payments if you're going that route, right? There isn't 100% financing on, you know, there's subprime loans. That's gone. So when people say, oh, we're in another bubble, I always ask why. Well, what is going to make it pop? What is that catalyst that causes this market to change? And the only thing I can think of is just hyperinflation, rates skyrocket, and the economy can't really handle that. So we go into a recession. But again, that's not a housing bust, right? That's just a recession. And so we might plateau, we might see a little dip, but you still have a supply and demand issue. There isn't enough supply for the amount of demand that people trying to buy homes. And that's not going to change. You have the largest segment of the population that are finally moving out of their parents' basements and buying homes, right?
Which is a very good thing.
Yes. Yeah. So.
But, and then you say, when you talk about inflation, all that. So rates are they've been historically low for how long now?
I feel like
3
my whole
years,
career.
5 years. I mean,
Right. It just keeps
Yeah.
going lower.
It
Yeah.
just keeps going lower.
Yeah.
You know, you refinance 5 years ago, like, oh, I'll never get lower. I'll never need to refinance again. And then lo and behold, you go from 5 to 3 to
Yeah.
2.75 all the way down.
Right.
How high you think it would have to go up for a slowdown? I mean, because let's face it, 5% is pretty good.
Yeah, I know, but you know, I think it's perception. You have all these people now that think that 3% is normal, right? Or 2.875 is normal. So if rates go to 4.5 or 5%, oh my gosh, that's awful, right? I would never buy a house with an interest rate that high because they've never seen anything like that,
Yeah.
right? So it's just perception. It's still historically a really good rate. And eventually we need to get there to have a healthy economy. You have to have rates go up a little bit. I mean, look, when our parents, grandparents were buying homes, they had savings accounts yielding 8, 9, 10, 11, 12%, and they had borrowing rates of 14, 15, 16, 18%. Right. And they still bought homes.
Yes, they did.
Right. So I think no matter what, people are still going to buy homes. I don't care what the interest rates go to. You're not going to see this crash.
Should have any new loan officer take a view of the interest rate chart for the last 30 years.
Yeah,
and
exactly.
Realize how low it's been for how long.
Yeah.
But it's not normal.
I show clients the chart, and when you just look at the 1-year chart, it looks like this, right? It's straight up because, starting in May of last year, the rates were almost at an all-time low. May, June, July, it was ridiculously low. And then things started trickling up when you look at the 10-year treasury. And so I have to expand it out now to like a 2-year chart, and you just see it like this, right? But when you really look back like 15, 20 years, it's up here. And that's why you said, like, we've had record low rates my entire career, because it went from 7.25 to 6 to 5 to 4 to 3 to 2.5, right? So yeah, I think we're gonna go sideways for a while. Rates are gonna stay relatively low. We'll trickle up a little bit, but it's not gonna have any impact on our market. I really don't think so.
Well, let's talk about the last year. Okay. I'm fully vaccinated. You're fully vaccinated. COVID was a stressor for everybody, but where do you think it helped you as far as efficiencies, like changing? Because everybody had to change their workflow a little bit, right?
Yeah, I was fortunate enough to be coached to hire, right? So I hired a massive amount of people to help support the volume that we were seeing. And I did that early on, like March, April last year, May. And I think that helped us handle the volume that was coming in. Even though the people might not have been seasoned, it certainly helped us. So now we have people that have been here a year and a half. We're operating on all cylinders. And so, we tweak little things along the way. We always have in our careers that help us be a little bit more efficient. We were sending everybody to our website to fill out an application. Now we're trying to take every application over the phone, right? Just to convert more. I never need more leads. I need more conversion. I need higher conversion, right? So for me, efficiency is just converting at a higher level at every step of the way, getting more credit repair clients to become clients, right? Getting more leads to fill out an application, getting more pre-approval applications to become pre-approved, right? And how many pre-approvals actually buy. And so we track all of that, and then you just tweak little things so you can improve that, right? And that's what we've done over the last, 16, 18 months. Just little tweaks, nothing groundbreaking.
And
right?
Picking up the phone still has the huge effect it always
More
has.
so than ever.
Yeah.
More so than ever. People want personal touch.
I'm going to pause for a moment, just ask another question that we have. So potentially you have a buyer, they've met with a realtor, they're looking at properties. What's the best tools, advice for both realtor and buyer you can give as the originator that's ultimately going to have to put this deal together and get it approved for them to have them the best prepared? Obviously, sometimes these buyers are in the market for a long time because they're putting on multiple offers, but their relationship with the realtor, for one question would be like, how long should they feel like that realtor is really working on their behalf? Because to me, I would think you'd have to have an aggressive realtor to a degree in this market. And then 2, what can the buyer do to be, because I see the disappointment and kind of not giving up, but you're really aggressively looking, right? You're a buyer, you have good credit score, you have the cash to buy.
You get discouraged.
And they get discouraged, but all of us want to make a deal out of this, and we have low inventory anyway. So not being able to convert these people is frustrating. So is there any advice to give, the buyer?
When I do my pre-approval consultation, I always tell the client, if you're looking in that 3 to 350 range, then start at 270 because you might have to bid 3, right?
Okay.
I always start lower at what you're looking at, because if you're at the top end of your range, you're never going to get it because you have to go over what you're qualified for to get it, right? Everybody is going over asking price, everyone, or you're not getting it. So that's number one. And we don't send a loan to underwriting as a to be determined. We don't do that. I just don't think it's necessary. Some lenders do. Some lenders send it through underwriting and they have an underwriting approval with a to be determined address. So our pre-approval letters are going up against some of those. And what I would say is to a client and to a realtor, we want to make sure we have everything up front. Because if we say a loan is pre-approved, it's going to closing. We have a really good reputation in the market. Realtors know who First Home Mortgage is. We're the largest privately held mortgage bank in Maryland. So, we do a lot of business in Maryland. And so if we say it's pre-approved, it's going to close. And we're competing against those that we are approved, right? And I just say, look, they still have to get an appraisal. You still have to get title. You still have to get home insurance. You still have to get all these different things and update the documentation, right? So let's just make sure all your documentation is up to date today. So when I talk to that listing agent, I could say, look, I have a 35 debt to income ratio based on the pay stubs I saw today, right? They got paid on Friday. I have them there, W-2 employee. It's all about that conversation with the listing agent. And if loan officers aren't calling the listing agent when the offer is being made and they're waiting for that call to come into them, they're losing. They're losing. Be proactive. Go out and make the phone call as the loan officer, right? And then for the client, I would say if you're not writing contracts the day you see the house, one of my real estate agents has a great sign in her office. It says something like, the house that you want to think about and sleep on tonight is the house somebody saw yesterday, slept on, and wrote today, right? So you can't sleep on it anymore. You have to write that day. That's like in this market.
You just got to make the decision.
Yeah, it's same day. Boom.
I think the key is the pricing, like you said, because if your heart goes in and your price point is 500 and you're looking at $500,000 houses, you're just disappointing yourself over and over again.
That's right.
So go under when you're looking, price higher.
Yep.
And you'll probably yield more success that way.
And never get your initial pre-approval letter. It's a generic letter that you're getting for some random amount. Don't put it at your max. If you're not comfortable with a $500,000 purchase, then don't get a $500,000 pre-approval, because guess what your realtor is going to show you? $500,000 homes, right? Get your $350,000 letter if you're comfortable with that mortgage payment of whatever it is, $2,000, right? And then go from there. If you don't find anything you like and you tweak your budget and now you can afford a little bit more, then maybe we'll increase it then. But let's stick with what you're comfortable with, not what the max is.
And that's a great piece of trust, because a lot of borrowers could afford more based on all the programs and the credit scores and all that, but it's figuring out what's comfortable for them instead of just saying, you can qualify for $3,500, but they're comfortable with $2,500,
right?
Based on what their life goals are and what
that's exactly right. Right, because in a debt to income ratio, there's a lot of things that don't go into debt to income ratio that we don't know about, right? They could be paying for private school or child care, or they're paying for their kids' braces or whatever, right?
Well, I think it's a different buyer too, and maybe you can talk to this, because like I see the millennials, they live a different lifestyle than like I did when I was raising my family. They have more sushi dinners and things of that nature. So their lifestyle is frankly a little bit more expensive. So they may not want what we would back in the day consider like pushing the debt to income on qualifying them. They might be more comfortable at like a 33 as opposed to us pushing a 48 in a scenario, right?
Chicken tenders at Fridays is now sushi at Joss, right?
Exactly. So that profile of buyer becomes a little bit more, a little bit more bougie. I'm going to use the word, but yeah. So I was just really worried. I was really concerned about the relationship with the realtor and the aggressiveness of the realtor, but in reality, it's really it sounds like it's more the offer.
Yeah. And we see a lot of buyers flip-flopping on agents. Unfortunately, you have that relationship with the agent and it's like, oh, I'm using a different realtor. It's like, well, why?
It's not really going to change.
Yeah. And look, if you're working with a pro, you're going to get a house, right? There's 10,000 realtors in the area, something crazy. And like half that or 80% of that, 8,000 homes on the market in Maryland. I forget what the statistic is, but there's more homes. There's more realtors than there are homes. So, you can find, you walk down the street, there's realtors in here. So it's about finding a pro.
Now, say you get a borrower that doesn't have a real estate agent. They came to you first to get pre-approved.
Yeah, which we see a lot of.
And I know you have a big stable of real estate agents that you work with, but what are some rules that you would say that for somebody out there that's looking for an agent, like
geographics, right? Like, so if you're going to buy in Baltimore County, I'm not referring you to an agent in Waldorf, right? And then I would say the programs, right? Program knowledge and price point. And are they hustling, right? Are these realtors really hustling. Most of the agents we work with are working their tails off, right? So I'd be happy referring them out to the 80 or 100 realtors that I work with, right? Every single one of them. So, but there's, you know, just like in any industry, there's a lot of people that just aren't working very hard.
And then don't use your buddy who got his license last week.
Yeah. It's tough, you know, unless your family member is, or buddy is, you know, one of the top agents in the area, you know, it's hard to use the family member that's had their license for 20 years, but has closed one transaction,
Mhm.
right? You want to use somebody with experience and, you know, knows what they're doing. Yeah. And it doesn't necessarily mean it's their full-time job. They can be a dual agent and still be really good. But you just want to make sure they have the time and capacity to handle your needs. Yeah.
So I'm trying to think, are there any other programs? So we have FHA, VA, home hospitals, all those.
Yeah.
Do you see any like new programs coming about through any other avenues?
We do price out some of the non-QM stuff.
Okay.
So we have, you know, in the jumbos, you could do a 10% down jumbo with some of these non-QM lenders, which is attractive, but the rates are going to be in the high 4s, right?
Mhm.
I have a client right now wants to buy a condo in Miami, 1.5 million, only wants to put 10% down. So that's the only option, right? It's non-QM. You know, other than that, it's, you know, we got 100% FHA with the Chenoa program, 640 credit score. So yeah, you know, no income limit on that program. So there's so many different options out there, even on the conventional side. I mean, between Home Possible, Home Ready, and then you have the Borrow Smart, you know, down payment assistance through Borrow Smart. There's so many options, and it's constantly changing. And now with the Biden administration, their money hasn't even hit us yet, right? All of that stimulus that's going to come out. Biden's always been a huge proponent of housing. So he is going to put a tremendous amount of money into the housing market through down payment assistance. I think there's a proposal for $20,000 for housing finance agency program. So, you know, kind of like what the Montgomery County Maryland mortgage program had, they were getting 20 or 25,000 out. So you're going to see that become normal, I think, this time next year, maybe at end of the summer even. And then with the potential first-time homebuyer credit of $15,000, that'll. So one of the things that this is going to do, all this stimulus is going to create more demand, right? And we're not putting any more supply on the market. It's just more demand. So it's good and it's bad, right? I don't know that we need more demand, but programs are good.
As far as the supply, though, you see the cities and the suburbs sprawling wider and wider and wider. So from a geographical standpoint, I think actually one of the benefits of COVID is people work from home more.
Yeah.
But you're going to see that
The sprawl.
sprawl.
Yeah, I agree. But the problem is there's nowhere to go to, right? So you might have a mass exodus out of the cities. At least you did, you know, last summer. But there's really nowhere to go, and the builders can't handle that business because the cost of lumber, the inflation on and the time, and there's, you know, just not enough land, right? There's nowhere to go. So something has to give. I don't know what the answer is. I really don't. It's
There's somewhere to go. It's called your parents' basement.
right.
I'm here to confirm that until they
Yeah.
find a home.
No parents' basements.
I wanted to stop. We're at like 40 minutes. We were trying to keep this at like 45-ish or longer if we need to, but I wanted to give the participants on the call an opportunity to ask questions. If you have a question for Ryan, if you could just unmute yourself, or Chris, unmute yourself and ask the question. We'll give you the opportunity to do that. They can still continue to talk, but I'd like to hear from some of you if you have something you'd like to ask. Just in general, credit-wise, your borrower, the Maryland mortgage program, questions about, you know, how that's utilized. Just helping the other originators or people in the industry on the call, if there's anything that we can give you to kind of boost your confidence in any of these arenas. Can you say if anybody's on? All right, well, we'll keep chatting. I did have a couple of questions that we had from earlier. When mentoring your LOs on the process, where do you start? Like, I think this was gauged more towards credit. Like a lot of originators aren't confident in the credit arena of rescoring somebody, or if they see, I see it all the time. I deal with brokers, and it's kind of like they don't meet the criteria, boom, you're gone, and they're on to somebody else. That's an opportunity. I looked at it as a lost opportunity and a relationship, right? Because that's how I was trained through all my years in the industry. How do you train your loan officers not to lose that opportunity?
Yeah, I mean, we really rely heavily on the Wayfinder and the credit assurer. So if you see that potential, I run it, right? I mean, if you're sitting in the low 600s and you see that 20, 30, 40 point potential increase, run it, and run that with your rookie loan officers or your trainees, loan officer assistants. So they start understanding, because eventually, like Heather on my team, she's been with me 11 years. She doesn't need to look at that anymore. She just looks at the credit. Oh, pay that down to $20, pay that down. You know, if we can get a deletion letter on that medical bill, the Equifax score will go higher. Like, you just learn over time what works. And it's just like anything else. Put in the time, put in the practice, look at as many credit reports as you can with your people.
And not just with lower credit, with higher credit as well, right? Like, so say you're looking at homes and they're looking for, you know, not that you're giving out scores when realtors and lenders are giving pre-approval letters, but let's face it, a stronger buyer is a better deal. Even those buyers could benefit from that, right?
Certainly.
So is there a place where you just say, oh, they're good enough?
Once they're over 740.
Okay.
It's like, they're good.
But if you're at 680 and you want to get to 720.
Oh, that's a big difference. Going from 680 to 720, that changes your rates. Your mortgage insurance is drastically different.
Homeowners insurance.
Everything. So it matters. It really matters.
So that's a value too. You have other originators that aren't going to even bother to do that, right? They're just going to take write it as is. Whereas if you're comfortable with utilizing some of these credit opportunities, you can potentially give your buyer.
You'll win a client over because of that. So we have clients that are shopping around. We might not have the lowest rate on any given day, right?
Right.
But if we can advise a client how to get the lower rate and the lower payment and the less out of pocket because their mortgage insurance is going to be cheaper, they're going to stick with us, because now we're going to do that rapid rescore for them, spend the $90 or whatever it is to do it, and teach them how. And look, most people don't know that you should keep your credit balances below 10% of the limit at all times,
Correct.
right? And so just by advising them that and adding value to the customer, right? If you add value, they'll use you. It doesn't matter what your rate is.
And those products, they're also really inexpensive. Like the rescore can be pricey depending on how many accounts you have. But to go through that process of doing credit assure and then doing the Wayfinder, and I would suggest for any new loan officers to start playing with the Wayfinder first, because it gives them a whole list of what can be done.
Yeah.
And after they're on there for a while, then they learn and they become as efficient as Heather that you were talking about. But she can look at a credit report now and just, I know where I'm going.
Add an authorized user or something of that as on an account. Because I find a lot of the younger folks, like I thought, because I'm in the business, I'm going to do a great job and give my kids wonderful credit, and they're going to walk out in the world and I did to a degree, but where I fell short, because I'm not an originator, you know, I'm in the wholesale arena, is I didn't get them installment debt. So I think maybe MMBVA could even like take this one step further and show how, you know, somebody coming from not having any credit and building credit, what would be important. Because my kids had like say 700 FICO scores coming out, but they could have had 800 or even high sevens if they had a car loan or something of that nature. And then I didn't realize how big of a deal that actually was. Having 2 or 3 credit cards isn't necessarily going to get you to those higher FICO scores, which and you could correct me, I could be wrong, but that's what I found when we went to buy my daughter a car.
So you start with a college kid who's, you know, young, has nothing. Okay. You want to get them 2 credit cards. Okay. I say 2 because in case you lose one, you have another one. So, but that'll build a score up to close to 800, to be honest, in a couple of years, just those 2 cards.
It'll generate a score in 4 to 6 months.
Yes.
Without installment. So
without installment. So it doesn't have to be installment. In fact, once an installment loan first goes on the report, you know, it's just like a mortgage, the score actually goes down because there's no history on it yet. Right. But then after 6 months, it will build that score up. But the installment piece isn't as big as getting them a couple accounts, you know, 2 or 3 accounts that get registered on a credit report, keeping them great for 6 months to start a score. And then once they get to a year, 2 years old, their score should be above that 760 mark, 740 mark to get them the best loans available.
Yeah.
So I would recommend.
I always advise
anybody get
against
something.
the installment loan to my
Interesting.
clients.
Okay, that's good to
Always,
know.
always, because it doesn't really have a positive impact on your credit until it's really paid off, right? I mean, it can be detrimental. If they have 1 30-day late, it's massively detrimental to their credit. So I always advise 2 to 3 revolving accounts if you have none. And maybe this is a good question for you. If I have a client that comes to me and all they really have is maybe some installment loans, and they're trying to buy a house fast, what's that first thing they should do?
If their score's good,
Decent, right?
decent,
yeah.
like to get it up. If they have no revolving credit whatsoever, it's a big piece of the score.
Yeah.
It's not there. Go get some.
Right.
Now, you're going to need 6 months to a year for that to really be positive.
But the opening
But they
of
have to
it,
do
once
it.
that, like 30 days, as soon as it hits the report, it should have a positive impact,
It
right?
should have a positive
As long as the
impact.
balance is like
The
$10.
balance is low.
Right,
$10.
yeah.
Just don't use that.
I
baby.
tell them, go put a tank of gas on it, pay it down to $10, and then go put another tank on it and put it.
But
down
you have to have an
$10.
available limit. So, you
Right,
know,
$500 credit limit.
I have
if you
a,
have a $500 credit limit with a $500 balance, that's
yeah,
bad.
that was going to be my follow-up question. So I'm going to ask my question, then I'm going to ask, we have a question from Frank on here that I'll ask next, but like potentially say your credit card is the credit extended is 3,000 and you have 2,800 on it. Is it more valuable to pay that down or just as valuable to call and get a credit increase? Does it matter?
Actually, if you can call and get a credit increase, make sure the percentages are where they need to be, but that doesn't cost anybody money.
Right.
And it will raise the score the next month because now you're going to raise that limit to say $8,000.
Right.
You know, so now you're under 30% of your utilization ratio. Credit
I don't think a lot of
utilization
people
ratio.
know that. And you just have to pick up the phone and
Right.
call these people. You can typically get a lower rate and an increase in
Right.
as long as you're doing your part and
That's
paying on
right,
time.
Yes.
And it's been open long enough.
Right.
Yeah.
So the question from Frank is, with 35 to 45 day requirement on the Maryland mortgage programs, how are you getting these loans closed in the market today?
How are we getting them accepted? We just do a lot of them. And so people know we get them. Oh, look, a lot of sellers don't necessarily need to close in 30 days. Some of them have a home of choice contingency and they have nowhere to go, right? So it's like, I sold my home. Now I need someplace to go. I'm fine with closing in 6 days. We have a few loans closing in July because these people have to find a home, right? So
Matching up the right buyer with
exactly.
the right seller.
It's very rare right now where there's a need, because you're seeing, even if they want to close in 30 days, they're doing a 30, 60-day rent back. It's like, what?
Right.
All right, can we just do a 45-day rent back and 45-day close? Yeah, okay, that's fine, right?
Okay.
They just think because you can close in 30 days, it's more attractive. It's a stronger buyer. And it's not. A Maryland mortgage program buyer is not a weak buyer. It's a strong buyer that's just taking advantage of an incredible program, right? And that's how I sell it. You know, if you know what you're doing and you have confidence when you speak to that listing agent, you could sell them anything.
Yeah, they're not going to be afraid of it because they know that, and they've done business with you before. So it's your reputation. You're not going
Right.
to give them a loan that's not going to close. May take a little longer,
Right.
but it's the right buyer and the right seller, sounds like. Let's make sure we don't have any other questions and then we'll let you guys wrap up if you'd like. I think we're good. If anybody has any other questions, either unmute or write them. And if not, we're going to let these gentlemen close up for the day. Do you have anything else you want to close with?
If anybody has any questions, you can email me. If you have anything personal you don't want to put on the chat, rpaquin@firsthome.com. Feel free to shoot me an email.
Ryan, thank you for doing that today.
Yeah, absolutely. My pleasure.
Great job.
Thanks for having me.
Awesome.